Thank you, Mr. Chairman. Chairman Bernanke, thank you for your service, as others have done, and we all mean that. And thank you for the new rules on capital standards that you have issued with OCC and FDIC. I urge you to hold fast on them when the mega banks fight to weaken those standards, and I hope that you will do that. Some financial institutions argue, as we have discussed, that we should not get out ahead of Europe in our financial regulation. On Monday, Governor Tarullo said, and I want to quote at some length, "I think it's very dangerous that some have tried to characterize Basel agreements as the ceiling, not the floor. So for us in the United States, those of us who are charged with financial stability of the United States need to make the judgment as to what levels of capital will most ensure financial stability in the country without unduly affecting the flow of credit." Ever since the publication of our proposed reg, I've had calls from my counterparts around the world, Chairman Tarullo says. "That's really interesting," they're saying. "Tell me the reasoning on this, how you're thinking about it. Explain to me more why you think 3% is inadequate," end quote. When I hear Governor Tarullo saying is that we should do what we think is best for our financial stability, and if we lead by example, the rest of the world will follow. Do you agree with Governor Tarullo?
I certainly agree with the first part, which is that Basel III is a floor. It's not a ceiling. It's really a least common denominator, because these agreements are made essentially by unanimous consensus, and therefore, if there are a few countries that are very resistant for whatever reason, you know, that makes it tougher to get the higher standard. So we view them as a floor, and we were prepared to do whatever additional steps are needed in order to make our financial system safe. I don't know whether all countries will follow us, but there are other countries, Switzerland comes to mind, UK, that have thought hard about this and have made taken additional steps to strengthen their banking systems. And we do have a leadership position, and I hope that will happen. But I don't think it'll be universal. I think that you'll see different responses from different countries.
But the most important countries with financial systems will follow, as Governor Tarullo suggests?
I don't know whether they'll follow the exact same things, but they've all got the key financial centers, which recognize how important banks are to their economy, but also the fact that in some cases the banks are bigger than their economy. Recognize that it's very important to have stability, and they have been particularly willing to consider additional steps.
So we should not shrink from doing the right thing for stability of our country because some mega banks say that we will be an outlier and other countries won't follow. Agree with that?
Well, the other countries may or may not follow. Some will. But whether they do or not, I do agree that we should do whatever we need to do to make sure that the U.S. financial system is safe.
Thank you. Let me ask another question. It's bank earnings season again, as you know, and it's no surprise that mega banks are doing quite well, yet they continue to claim that new regulations, impending regulations are killing them. Tuesday's Financial Times said, "Here's the problem. Banks have spent a lot of time, energy, and money warning of the potential ill effects of ramping up regulation, but since the crisis, international regulators have kept demanding more capital, including a surcharge for the bigger banks, as you said. Lenders have doubled their capital levels as a result, hitting the new Basel III targets 6 years early in some case, and yet," Financial Times asks, "where are the ill effects? The best of them continue to set new profit records with every earnings season. Warnings of calamity look more and more hollow," unquote. The debate about the Fed's new proposed supplementary leverage ratio reminds me that when we think about costs, we as policymakers, regulators, and elected officials, when we think about costs and benefits, industry wants us only to think about cost to them. Steel companies dump waste into our rivers, and then they argue that it will be costly to clean it up. It's a higher human cost to the miners and the children who get sick from the pollution. It passes more health care costs onto our society, clearly, as they fail to internalize those costs. Those who believe in a society with rules understand that auto safety might cost car companies a little bit more for airbags and seat belts and other safety features, but these protections save lives. The same with financial rules. They might cost bank executives a little bit more in smaller bonuses and maybe even in dividends, but they'll help prevent a repeat of what we had 5 years ago, where the costs obviously were shifted to the broad public in retirement savings, in lost jobs, in every way imaginable. And certainly people's lost homes. If these are the costs of a safer financial system, aren't they worth it?
The crisis was an enormous waste of resources, and its unsafe practices by large financial institutions pose a risk not just to themselves but to the rest of society. And in setting policy, we should look at the social cost and not just the cost to the firms, and that's what we're attempting to do.
And if it means the bonuses are a little smaller and that dividends are a little less and the earnings reports of the banks aren't quite up to what they were this quarter, which was pretty lucrative quarter for them, that's a price we should pay
I think
as a society.
From a cost point of view, I think what we should be looking at is whether there's any effect on credit availability, things of that sort that affect our economy more broadly. But I certainly agree that, again, given the enormous cost of the crisis, that strong measures to prevent a repeat are obviously well justified on a
Are you
cost-benefit
concerned
basis.
that these higher capital standards will result in less credit available?
I don't think so. No, I'm not concerned about it. We've done some analysis of that, and there's not much evidence that would be
There's
a
not
problem.
really much downside if you said that higher capital, that you said that the biggest potential problem with rules is, does it mean less credit available? If it doesn't mean less credit available, there's no real downside for strong capital standards.
The only downside I can think of is that credit flows may find, if banks are finding themselves finding it very costly to make loans, then credit may start flowing through other less regulated channels, and those have to be monitored.
But
as
you're not implying at all that we're there yet, even close to that situation with capital standards.
No, we're not there yet, but we have to watch the shadow banking system and other parts of the system and make sure that risks are not being offloaded into other parts of the financial system.
Okay, thank you, and Mr. Chairman, thank you for your generosity of time and